Hey guys, Chris from adapttuition here, and this is video number 3 in my ratio analysis series. If you want to see the other videos in this playlist, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. So in my previous 2 videos on this topic, I talked about profitability ratios and liquidity ratios. In this video, I'm going to talk about efficiency or activity ratios. But before we get into talking about that specifically, I just wanted to say a few words generally about ratio analysis, what it is, what it's used for. So ratio analysis is used to assess performance. When you guys do your tests in school and you get your percentages or your marks, those are ratios. A percentage is a ratio out of 100, and if it's not a percentage, let's say it's not like 17 out of 20 or 15 out of 35, that's also a ratio. It comes from the mathematical term a rational number, which is a fraction, the ratio of a numerator to a denominator. Now, I know some of you all want to click away when you hear me talking about math. I promise I'm getting back to accounts now. So if you, for example, get a series of your reports, progress reports, whatever you want to call it, and you see your marks in a particular subject going steadily downward, you may have a problem. You may want to know, well, why am I not doing well in that subject? You see, you're analyzing, you're assessing what's going on, and you're analyzing what is happening to cause me to get these bad marks. Maybe I need to change my study habits. Maybe I shouldn't have a playlist on YouTube with my tablet open playing a game, and maybe have social media ringing off continuously and messaging apps open on a third laptop or whatever the case is. Maybe I need to cut out all the distractions and focus on my work. Could be a possibility, right? Okay, now on the other hand, let's say you notice your marks are going up, an upward trajectory. You were getting 70s and 80s and 90s and a maximum at 100. So now you may want to ask, okay, well, what is the reason for me doing so well in this particular subject, and can I replicate it in other areas? Maybe you have a pretty good teacher who's inspiring you to have good study habits. Like for me, in school, when I was in Form 4, Form 5, my econ teacher did a fantastic job of that. And because of him, I used to study every day when I went home and do most of my assignments on time. I say most because 1 or 2 little subjects I wasn't a big fan of, but I still tried. But we all have that struggle, right? Anyway, so businesses also need to assess their performance, because remember, people invest money in businesses and they expect a return on their investment. And we of course have to manage our liquid resources, our cash resources, to know if we have enough to make payments on our obligations or liabilities. So we need to assess how well we are doing in different areas. Again, we talked about profitability, we talked about liquidity, and in this video we're going to talk about the efficiency or activity ratios. Okay, so here we have efficiency or activity. So it says efficiency in this context refers to how well the entity is performing certain critical activities, namely the sale of goods, the collection of accounts receivable, and the repayment of accounts payable. Right, so these are critical activities, because let's take a read of some more notes here. It says the sale of goods is necessary to earn revenue, which in turn will be used to pay for everything else. And we saw this in our video on profitability ratios, specifically with the gross margin, the net margin, and the operating expense margin. We saw that the sales revenue is what is used to pay out all of these things, to pay for your cost of goods sold, to pay for your expenses, and to quote unquote pay the owner their reward of profit. So out of your sales revenue, you pay everything. So the sale of goods is what drives your revenue generation. So we need to assess how well are we doing on that front. And next, right, so some portion of total sales will usually be on credit. As such, the entity needs to collect receipts from its trade debtors on a timely basis to ensure that it has the liquid resources to settle its obligations. So so you're making your sales, some are for cash and some are on credit. And if you make credit sales, you need to collect the money that your debtors promised to pay you. Otherwise, you're just giving goods away for free and you are losing money. So you don't want to do that. So that's something else we need to pay attention to activity-wise. How well is the entity, the business, doing in terms of collecting its receipts from debtors? And finally, to have inventory to sell in the first place, the entity will usually purchase from its suppliers. Some portion of these purchases will be on credit. As such, the entity needs to ensure it repays its trade creditors in a timely manner, or it risks losing its suppliers as its source of inventories. So the following ratios will help us to assess the entity's efficiency for these vital activities. So again, in order to have your inventory, you need to buy it or manufacture it. But even if you are manufacturing, you have to have a supply of materials. Where does it come from? It comes from your suppliers. And to keep his suppliers happy, you need to repay them on time, or as I said, in a timely manner. And if you don't, you risk one, incurring interest charges on your debts, your liabilities, or two, you risk your credit drying up. What that means is that your suppliers will no longer extend you credit. You will have to purchase for cash, which may not always be as readily available as you would like. But of course, with proper liquidity management, it could be. Anyhow, let's take a look at the calculation of these ratios. Okay, so the first ratio we are going to take a look at is the rate of stock turnover. We have a formula which is cost of goods sold divided by average inventory or average stock equal to X times per year. And average inventory, so we kind of met this concept of average. I mean, you all would know the concept of average from your math class, I hope. But when we met average capital, that was opening capital plus closing capital divided by 2. Here we have opening inventory plus closing inventory divided by 2. So we use that as the denominator here. So what this does is it tells the sale of goods is necessary to earn revenue, which in turn will be used to pay for everything else. We said it already. And this ratio tells us how many times in a year the entity is selling out its average stock. So let's take a look at an example of the calculation. Okay, so we're taking a look at Bing Nap Ding Bat, right? So it's cost of goods, so we have inventory at start plus purchases. So we're not worrying with carriage in or returns out, we're keeping it simple. We add those two together, we get cost of goods available for sale minus inventory and giving us cost of goods sold. Okay, let's scroll down to see the other information. So to find the rate of stock turn, which I've abbreviated as ROST, we need the cost of goods sold divided by average inventory. Now, our cost of goods sold was given to us. In some questions, in some CSEC exams, you have to calculate that cost of goods sold. So be sure you know how to do it. If you're not sure, I'm going to put a card up there and a link in the description below to my trading account video. Now, it's one of my first videos, so it's not my best quality, so be kind if you watch it, right? Right, so we have the cost of goods sold. To find average inventory now, we need to add opening and closing and divide by 2. You're going to see that calculation down here. 8 and 12 is 20, 20 divided by 2 is 10. And we're going to put the 18, the cost of goods sold, and the average stock, the 10, in this formula up here. 18,000 divided by 10,000, giving us 1.8 times. So that means you sold out your stock 1.8 times per year. So that sounds kind of low, but again, I'll get into some explanation about that a bit later on, right? Let me give you guys Split Tax, our trusty example company. So we have inventory at start, add purchases, giving us cost of goods available, less ending inventory, giving us cost of goods sold. Now, I want you guys to take a pause, try the calculation, then unpause and we'll correct it. Okay, did you try it? Let's take a look. So first things first, let's calculate average inventory. So I'm seeing inventory at start is 16, inventory at end is 8. So we're going to put the 16,000 plus the 8,000. Whoops, forgot my comma. And we're going to divide by 2. So 16 and 8 is 24,000, and divide by 2, that's going to give us $12,000 worth of average inventory, right? So we're going to put the 12,000 as our denominator, and we're going to put the cost of goods sold as the numerator, and we are going to divide. Now 60 divided by 12 gives us a nice flat figure of 5 times, and it's actually 5 times per year. All right. So if we had to assess which company was doing better in terms of selling out stock faster, which company would you say? Would you say Bing Nap Ding Bat is doing better, or Split Tax, and why? Now, from what I could see, I feel like Split Tax is doing a better job because it's selling its stock faster, which means it's earning revenue more quickly. It's more efficient in terms of its revenue generation than is Bing Nap Ding Bat, who's only selling on stock 1.8 times per year. So that's relatively slow compared to Split Tax. So once again, remember, it's all relative. When we compare, that's when we get some sort of meaning. All right, but again, we need a lot more context. Like you guys would probably be fed up of hearing me say by now that this is a double-edged sword, that we don't have all the information. We don't know exactly the reason why these ratios are, why they are, the values they are, but we can, therefore, use our brain, flex our imagination to come up with logical reasons. Now, sometimes when they come up with reasons, they may not be too logical, they may be wrong, but that's okay. That is part of the process. Do not be afraid of making mistakes. They are our friends. They help us know what not to do. Okay? All right. Okay, so what we're going to do, we're going to take the rate of stock turn and turn it into a number of days, weeks, and months that it takes to sell out the average stock. So it's called the sales period, and you can call it sales period in terms of days, sales period in weeks, or sales period in months, right? So what we do is we simply take the number, the requisite number, whether it's 365 for days in a year, 52 for weeks in a year, or 12 for months in a year, and divide it by the rate of stock turn. So for Bing Nap Dingbat, you're seeing I have 1.8 times per year. So sales days, 365 divided by 1.8 will give us 202.78. Sales weeks will give us 52 over 1.8, 28.89 weeks. And sales months, 12 divided by 1.8, which is 6.7 months. So this is telling us that it's taking a little longer than 6 months to sell Bing Nap Dingbat's average stock. So that seems a little long. And again, we need context. So for example, in these COVID times, economic activity is relatively slower than it normally is without this whole pandemic and lockdown situation. So 1.8 times might be really good. It might even be above average. But again, we don't have an average to which to compare it. So again, you see, information is very, very useful in providing context. Right? So again, the double-edged sword. Right? We don't have the information to know exactly what's going on, but it's bad because we can't give the exact reason, but it's good because we could flex our brain muscles, okay? Right, so I want to give you guys a couple of minutes to do split tax. So the rate of Stockton is here. So I want you guys to do the parallel calculations, right? You can use the same formulas from the left-hand side. Pause, try it out, and unpause, that's correct. Okay, let's take a look. So we'll do 365 over 5, which I believe is 73. Right, and then we will do 52 weeks in a year divided by 5, which is 10.4. And then we will take months, 12 months in a year divided by 5, and that'll give us 2.4. All right, so if we were just to go on these numbers, so it looks like Spagoogie Tax Incorporated is definitely more efficient. It's selling out its stock at a quicker rate than is Bing Nap Dingbat. All right, let's take a look at the next ratio. Okay, so this ratio is the account receivable or debtors turnover. The formula is net credit sales divided by average account receivable, and it tells us how many times per year we collect our average receivables. And of course, average receivables is opening and closing receivables divided by 2. Now, not every question will give you both opening and closing receivables. You might just have closing. If that's the case, just use that figure, right? Don't make it a big thing. Further, if you have two balance sheets for the same company and they want these two ratios, so what's going to happen? Let's say you have one for the year ended 31st December 2018 and one for the year ended, as at 31st December 2019, right? Now don't use the average debtors for the 2019 because remember the closing debtors of 2018 will be the opening debtors for 2019. So you could do average for 2019, but you can't do it for 2018 because you need 2017's closing debtors. So if you have a situation like that where you have 2 consecutive years, don't use average receivables for one and not the other. You need to have parallel computations in order for your ratios to be comparable, right? That's very important. So if that's the case, just use the closing for both of them, right? But in my examples here, let's scroll down and take a look at my examples. Okay, so we have Bing Nap Dingbat selected financial info for the period ended blah blah blah. Net credit sales, account receivable at start, account receivable at end. All right, let's take a look at the calculations now. So average receivables will be 16 plus 8 divided by 2, which is 12. And the net credit is 120. So 120 divided by 12 is just 10 times. So this tells us how many times during the year we collected all the money that debtors owed us, right? So that's a nice figure, 10 times. So it means that's almost once a month, right? So, I mean, 12 months in a year. So that was pretty good, okay? But again, relative to what? So what I'm going to do now is I'm going to give you guys a chance to do your own calculation. Check out Spagoogie Tax here, take a pause, do the calculations and unpause to correct. All right, are you ready? Okay, so the the average receivables will be 11,000 plus the 9,000 divided by 2. So 11 and 9 will give us what? 20,000, right? 20,000 divided by 2 will give us 10,000. So we're going to use that as our denominator here, and our numerator would be the net credit sales, which is 600,000. 1, 2, 3. So 600 divided by 10 gives us a pretty big figure of 60 times. So just when we thought Bing Nap Dingbat was looking good in terms of the number of times, here we have Spagoogie Tax going to blow them out of the water. All right. So I just want to talk about something real quick here, right? So as you should probably see the notes down here, it says there's no one right value for this ratio. The optimal range depends on several factors, which will be mentioned later in this handle. I actually didn't because I forgot, right? With that said, the entity should endeavor for it not to be too low, which would mean it is taking too long to collect receivables, which in turn could negatively affect liquidity. If you take too long to collect the cash, what's going to happen is your existing cash will run out when you have to pay your own liabilities. So you need a constant inflow, or at least a continual inflow, in order for you to be able to have a proper liquidity situation maintained on a consistent basis. Right? It should also not be too stringent, as this may discourage customers, from purchasing from the entity in the future. You don't want to harass your customers to pay, and you also don't want to give them like 1 day to pay. Right? I think the custom is to give them 2 to 4 weeks, in some cases 1 to 3 months, depending on your relationship with the customer. Okay, so if everybody else in the industry is doing one thing and you are being harsher than they are, the customers will just go elsewhere, unless your goods are really, really good. Okay, now again, just like we converted the rate of stock turn to the sales period, we could convert this to the debtors collection period. So this is debtors turnover. Let's take a look at the debtors collection period. Right, so also known as the accounts receivable collection period. The debtors collection period is how long it takes us on average to collect our average debtors. And the logic is the same as in the previous set of ratios. We take the requisite number, 365 for days, 52 for weeks, 12 for months, and divide it by the turnover. So for Big Nap Dingbat, we had 10 times per year. So for sales this shouldn't be sales days. I copied and pasted badly. Okay, so fix that. So the collection period in days is 365 divided by 10, so that's 36.5 days. That's a little over 1 month. In weeks, 52 divided by 10 is 5.2 weeks. And as we said, collection period in months, 12 divided by 10, which is 1.2. Now, you may be asking, which of these do you use and when? The question will tell you. If they want the debtors collection period, they should specify whether they want it in days, weeks, or months. If they don't, you could choose whichever one. All right. I don't know that there is a convention. I would probably go with days, to be honest. I think days are the easiest one to use. But again, that's a matter of opinion. Okay, so I want to give you guys a minute or two to try split Greek tax, which I'm showing you guys now. And actually, this should say 60. Okay, check it out now. Okay, so let's go. So we have 365 divided by 60. That's going to give us approximately 6.1 days. Okay, now of course the decimals might differ between you and me, but that's not a big deal, right? Once they're not off by too much. In weeks, we have 52 divided by 60, right? So that gives us 0.87 weeks, so less than a week. So well, that corroborates with what we saw earlier, 6.1 days, right? And in months, we're going to take 12 and divide by 60. Well, that's a simple case of 0.2 months. All right, so which is a whole month less than Big Nap Dingbat. All right, so again, if you were to do a comparison, you would see that split Greek tax is doing better than Big Nap Dingbat. All right, okay, we have one more ratio to take a look at. Okay, so this ratio is called the creditors turnover, and the formula is net credit purchases divided by average accounts payable, which gives us the number of times per year we repay our creditors, which I said earlier is very important. And of course, average accounts payable is opening accounts payable plus closing accounts payable divided by 2. Okay, and some additional notes. So if the net credit purchases figure is not given or cannot be found simply, use whatever purchases figure is available. And if only the closing balance for accounts payable is available, then use that figure. Okay, example time. Okay, so for Big Nap Dingbat, we have net credit purchases and we have opening and closing payable figures. Right, so 18 and 12, that's 30. The average of which of those two figures is 15. So we're going to take the net credit purchases, 180 divided by 15. That gives us 12 times. So we're paying back our creditors 12 times per year. That's once a month, isn't it? All right, let's take a look at split Greek tax. You guys take a look at it, try it out, and then unpause. Okay, let's take a look. So the average accounts payable would be 30,000 plus 20,000, divided by 2. That's going to give us 50,000, right, divided by 2, which is 25,000. All right. So now we're going to take the net credit purchases, which is 500,000, and divide by that 25,000. Oops, one more zero. There we go. And that's going to give us 20 times. All right, so again, split Greek tax is repaying its creditors 20 times per year. So almost twice a month. All right. Okay, let's take a look at a little additional note I have down here. So again, there's no one right value for the ratio. The optimal range depends on various factors, which again were to be discussed later in the handout, but I forgot to do it. What one should bear in mind is that we do not want to stretch our liquid resources too thin. So it is usually a good idea to collect from debtors before you pay creditors. However, there may be times where we would need to repay our trade creditors before we receive money from our trade debtors. In such cases, we may need to borrow funds from financial institutions, take loans, to repay our creditors or risk interest accruing or falling out of favor with our suppliers. So that's something to be aware of. Now let's take a look at how we could change this into days, weeks, and months. Okay, so we call this the accounts payable or creditors payment period or repayment period, and basically it's how long we take to repay our creditors. So again, we simply take the requisite number, 365 for days, 52 for weeks, and 12 for months, and divide it by the payables turnover. I don't know why I have 11 times here. Let's put that at 12, right? So 365 divided by 12 is 30.4 days. 52 divided by 12 is 4 and a third weeks. And 12 divided by 12 is 1 month. So yeah, we take about 1 month to pay our creditors. So I want you guys to try it for split Googie tax, and it was 20 times. So take a pause, take a calculation, and then unpause to correct. Okay, let's do it. So we have 365 divided by 20. So that's going to give us 18.25 days. Then we could do 52 divided by 20, so that's going to give us 2.6 weeks, I believe. Is it? Yeah, I feel so. Then we're going to have 12 divided by 20, which is 0.6. Yeah. Okay, cool. All right. So and again, so it looks like the Googie tax is doing better in terms of repaying faster than Bing Nap Dingbat. And of course, you'll take it into consideration with the ratios from above as well, right? It's always also collecting money from its debtors faster than Bing Nap Dingbat was. Okay. All right. Okay, guys, so there you have it. Those are the efficiency or activity ratios. Now, just a note, if you go on the current iteration of the CSEC syllabus, CSEC PoA syllabus, being in the 2021 version or whatever you want to call it, right? Some of these ratios are not there. The only one they really have is the rate of stock turn. Now, before you blow a gasket and wonder, why am I teaching this on the syllabus? Because I firmly believe these other ratios are worth knowing. I don't think that the syllabus is the gold standard of accounting knowledge. And I honestly feel I have discrepancies with it, so I'm teaching what I believe is good knowledge for you to know. And in any case, if you plan to do accounting at the CAPE level, these ratios are there and they are classified as efficiency or activity ratios. The funny part is on the CSEC PoA syllabus, they classify the rate of stock turn as a profitability ratio. I could kind of maybe wrap my head around why they might do that, but I think it's better classified as an efficiency or activity ratio. But again, that's just my opinion. All right, maybe people who have higher qualifications than me can explain why and justify why it's more accurately classified as a profitability ratio than an efficiency or activity ratio. But until they do, or maybe you guys know, if you know why, put it in the comment section below. I'm very eager to hear. Right, I've done a bit of Googling. I have not found a satisfactory explanation why, but sometimes that happens. It's just out there and I just can't find it. All right, guys, so that's about it for this video. If you want to check out more videos, I'm going to put some cards up here. Don't forget to subscribe to my channel and click the notification bell so you know every time I drop a new video. And be sure to check out my website to get some free PoA handouts. Anyway, guys, thank you so much for watching. Take care of yourselves, and I'll see you next time. Bye.